Hello, what's going on, folks? My name is Chris, and in this video, I'm going to talk to you all about margin trading, specifically how margin trading works in an Interactive Brokers trading account. And this video is going to be one of the best on YouTube that explains it in the most possible detail. And at the end of this video, you are going to feel 25% smarter. So in this video, we're going to cover what is a margin requirement, why it's a benefit, how it gives you more flexibility as a trader. I'm going to show how to view your margin requirement for individual positions in Interactive Brokers trading software. We're going to talk about how margin works for different asset classes like futures, stocks, options, bonds. And then I'm going to go over how I think you can reduce the possibility of getting a position liquidation or a margin call, as other brokers would call it. Stay tuned for this video. I really think that you guys are going to benefit from it, especially if you are in your first 1 to 3 years of trading. I've been trading since 2018. I've had a couple of margin calls myself, and especially those happened in the first couple of years when I was really learning about trading. So if you are learning trading, this video is going to be very beneficial for you. And because I have a lot of experience making videos, I can make this video for you and communicate to you the information in a very precise and accurate way. If you appreciate my work, let me know with a comment down below. And the easiest way to support these videos is by clicking on the first link down below and checking out Interactive Brokers. If you do that, it really helps me out. So thank you very much. More videos like this are coming in the future. What is margin requirement and why is it a benefit? Why is it even a thing? In the United States, you have to understand that the stock market and the futures market is regulated by the US government, and there's different institutions that regulate these markets. For stocks, it's the SEC, and for futures, it's the CFTC and the NFA. Basically, these institutions require brokers to follow a lot of different rules. One of them is regarding rules for capital requirement. So for Interactive Brokers, you have the Reg-T margin, which means that when you're trading stocks, you can get anywhere up to 4 times leverage on your money. And then there's another type of margin with Interactive Brokers called portfolio margin, which you can get sometimes more margin or more leverage. Other times they give you less leverage because they use your portfolio as the calculation for how much leverage you get instead of the margin being calculated on an individual symbol basis. Okay, so guys, in this video, I'm giving you tons of golden tidbits about how margin works with Interactive Brokers. So by the end of this video, you guys are going to know a lot more about how margin works. Instead of going through and reading through all the Reddit forums, you don't know if any of that is accurate. So in simple terms, the margin requirement is the capital requirement for a position. Depending on the asset class, it could be stocks, forex, futures, bonds, crypto, or options. The margin requirements are going to be different. So it is up to you as the investor, as the trader, to determine what you are going to do and how you're going to manage based around those margin requirements. Some traders might decide that Interactive Brokers has too high of a margin for their particular trading strategy. Some other traders might realize that that high margin is actually a good thing once you look into a bit of the fine print, and I'll give you a couple examples of that later. If you had to ask me, what's the main benefit of a margin account? This is the simplest answer for me. It would be, it just allows the investor a lot more flexibility with what they can do with their trading account. So with a regular cash account, which is a non-margin account, you have to wait normally 1 to 2 trading days before your trades have settled. Oftentimes, Interactive Brokers will let you trade with the unsettled funds at least one other time. Let's say you buy a stock, then sell it, and then buy another stock with the money you made from selling the first stock in that short period of time before the first stock trade has settled. You've traded the second stock using unsettled funds. You can run into a scenario where the broker will not let you sell the second stock because you bought it using unsettled funds. If you have a margin account, you will not experience this problem because with a margin account, it gives you the flexibility of borrowing funds from the broker if necessary, and you're not going to be subject to these rules where you have to wait for funds to be settled. The main benefit of margin is it gives you less capital requirement for trading stocks. And the other benefit of it is that you can use this margin benefit in a variety of different ways as an investor, as a portfolio manager. Off the top of my head, here's one of them. I'll just throw it at you right now. Let's say you have a portfolio of $50,000, like in this case right here. What you could do is you could buy US Treasury bills. You can buy 50,000 worth of US Treasury bills, and your margin requirement for those Treasury bills is not going to be 50,000. It's going to be something like maybe 1 or 2 or 3,000, and I can even show you that right now. So I'll go into my quote board here, and I have these US Treasury bills here, and I'm actually going to go ahead and just purchase, let's purchase 50K worth of treasury bonds. Okay, so I've purchased 50,000 worth of US treasury bills here in this demo account, and you can see there's the position in the account. And if you look at the maintenance margin, you can see the maintenance is 677. I'm going to tell you exactly what these fields are, but in short right now, maintenance is basically how much capital required for the positions in your account that are open. So I now have an open position of 50,000 worth of US treasury bills. The broker's only requiring me 677 CAD for this position. The reason it's saying CAD is because that's the base currency of this account. It's always going to show it in that currency. Here's an example of how this position could assist me as a trader. Let's say I'm an active futures day trader and I'm trading the S&P 500 futures, or maybe some treasury bond futures or whatever it is. So let's say I'm trading the ES futures. What is interesting about futures is that you don't actually pay any money to enter and exit a futures position. So if I buy the S&P 500 futures and then I sell it for a win or for a loss, that money is directly deposited into my account immediately. But in order to initiate that position, I did not use any money. What I used was margin. The broker is obligated to take a capital requirement out of my account in order to have positions in futures. So what this would do for me as a trader is I have this position of treasury bills, and this position is actually earning me interest. I purchased these treasury bills at a discount. So the way treasury bills work is you purchase them at a discount from their face value, and upon the maturity date, they pay you the full value of the bill. How this can benefit me is because over time, I'm trading this futures contract, right? So I'm going into the market and I'm trading ES and I'm generating trade commissions on that. The bond here is generating me a small return in the background while I'm doing my active trading. Therefore, it is acting as a hedge against my active trading activities. It's acting as a hedge against my trading commission fees. So let me just show you what happens when you initiate a position in ES futures. So I'm going to just place an order here for one contract on this ES futures contract. And when I place the order, you'll see the order confirmation window. On the left side of the order confirmation window, this is the notional value of the futures contract. This is the actual value, like what it's really worth in dollars. But you don't have to pay this amount of money to enter this position. That's the point of a margin account. With futures especially, because futures are already leveraged products. So this market trades on the Chicago Mercantile Exchange. Right away from the exchange, they're already leveraged products because the margin from the exchange, it might be anywhere between 5 to 20% of the notional value of the futures contract. You're not really going to have to put up more capital than that. So as an example here, look on the right side, this is where you see your margin impact for the position that you are about to put on. I'm going to show you some more examples of this as the video goes on. But what they're telling us here is that to buy one ES contract, the initial margin is 11,806 and the maintenance margin is 10,732. What this means is that when I put on this position, my maintenance margin is going to jump from 677 and get increased by 10,732, and my new maintenance margin is going to be 11,410. What this means is that I now have to maintain a minimum of that number, 11,410, in the account to avoid being liquidated or margin called. Now let's go ahead and transmit this trade, and let's just get filled on the order here. So now I'm in this position, and if you look at my account, you can see the maintenance margin has changed to the amount that I just told you about. But if you look at the cash did not change. Remember, I spent 50,000 on bonds. So what you're seeing here is that I've entered into this futures position, but I did not use any cash. So when you trade futures, you're not using any upfront cash in your account to initiate these positions. So that's something to know that's very unique to how futures work. It's not the same with stocks. So this was an example of how you can use US Treasury bills to act as a hedge against your active futures trading, or even potentially swing trading, depending on how often you trade. If you trade even 10 times per month, the income that you earn from investing your cash in a treasury bill is going to hedge against some of your trading commission fees, which at the end of the year is going to make a difference. I'm going to keep this T-bill position here just to show you that, well, I'm invested 50,000 into US bonds. I have an extremely low capital requirement for this position, but keep in mind, I also have a negative balance of 50,000 US dollars. And do not be alarmed when you have a negative balance in a margin account. I'm going to explain to you what this means and how this impacts you in a second. But for now, for the purpose of this example, to make things simple, I'm going to take that Canadian cash and convert it into US dollars. just because I do not want to be short the US dollar. Right now, I'm short the US dollar. If I'm expecting the US dollar to depreciate against the Canadian dollar, then that might be a justifiable reason to stay short the US dollar. But if I am currency neutral and I do not have any underlying bias about what the exchange rate is doing between these two currencies, then most probably I don't want to be maintaining this negative balance, because that balance is going to be costing me some money every month. Okay, so for now, what I'll do is cover the negative balance, because I want to show you some examples of trading US stocks. So I'm going to buy 50,000 US dollars. So let's just assume for this account, we bought 50,000 worth of bonds and we have 154 now left in US dollar cash. Just ignore the 17,000 here in Canadian, just pretend it's not there. So we'll do an example with a US stock. So regarding trading stocks with Interactive Brokers, this is very important to know. Each stock has its own margin requirement, which is set by the broker. And they set this depending on whatever their systems think the margin requirement should be. Obviously, they probably have a very sophisticated mechanism for how this works. You need to understand that every stock is different, and some stocks don't even have margin at all. Some stocks actually require you to pay more than the notional value of the stock you're buying. And I'll show you that here in a second. So when I go over to this stock, AAPL, Apple Inc., I have an iPhone, but I think it's going to be my last iPhone ever. Doesn't matter. I'm going to place an order to buy 30 shares of this stock here. And I'm going to transmit that so we can see the estimated margin impact. So the notional value of these 30 shares is $5,825. So go ahead and look at the right side columns, and we will see that the initial margin, which is how much the broker is actually requiring us right now to initialize a position on this stock, is 2,613. So just by a rough estimate, it's about 50%. So the total value of the stock is, let's say it's 6,000. The initial margin is 2,600. You're looking at about a 50% capital requirement for this particular stock. So I can go ahead and buy this stock. It would not be a problem. And what you would see is that when I buy the stock, my maintenance margin is going to increase to 3,502 from its current level of 1,127. And that would be absolutely fine because our bond position is not requiring us much capital. Now, the last thing I want to say before I place this order, which is extremely, extremely important to understand, is how the margin loan works with stocks. And it's basically this. If you have enough cash to pay for the full notional value of the stock, then your cash balance is going to be used to pay for the stock. So if I had $5,825 in cash in this account right here, which I don't, it's 154, it would use that cash balance to purchase these 30 shares. You will only be using your margin capabilities once your cash balance is going below zero. And that's why I said, do not be alarmed when your cash balance is negative. It could actually be a very good thing depending on your trading strategy, depending on the circumstances and your investment strategy. Margin investing, margin trading is not for beginner investors. That's why you need to watch this video until the end so that you can fully understand it to a greater degree. If you do not have the cash balance to pay for the shares, then you are using the margin capabilities in your account and you will incur interest on the negative cash balances. Again, I'm going to talk more about that later. Now, let's go on and look at a different stock here. So this is a different stock. It's a small cap or, lower market capitalization stock here. And I'm going to place an order on this stock and then look at the margin requirement here. As you can see, the price of this stock is about $13.49. And I'm going to transmit this order. And if we look at the notional value of the shares that I'm trying to purchase here, it is $404.70 US dollars. Let's go ahead and look at the initial margin. It is 551. That's a little bit weird, isn't it? Because this 551 is actually higher than 404. This is a prime example of a stock with a higher margin requirement than its actual value. So you're actually paying more than 100% capital requirement to trade this stock in a margin account. You would actually be better off trading this stock in a cash account if your only concern was capital requirement. Because for whatever reason, Interactive Brokers' systems has identified that this stock, for whatever reason, is higher risk, and they're actually requiring more than 100% of the notional value of your trade for this to go through here. If I buy $404 worth of this stock, my maintenance margin is going to increase by $500, which is odd because I'm only buying 400. Okay, so there's an example of that. So the other thing I wanted to show you is that when you do go ahead and buy the stock, I'm going to buy it at a price that's probably not even the real price. You'll see that it uses your cash balance. You can see now my USD cash balance is minus 252, as opposed to trading the futures where it does not use the cash balance. How to view your margin requirement for individual positions in your account. It's very easy. The simplest way would be to go into your portfolio window. If you do not have your portfolio here, go to new window and then select portfolio. And then in your portfolio window, you can just right click on the symbol and then go to financial instrument info and then select show margin impact. This window will show the margin impact of that individual position and the impact that it will also have if you decide to close that position. If you select new window at the top left and then go to portfolio tools, if you go to their risk navigator, that's another tool you can use to see your margin requirements for individual positions. Okay, so with Interactive Brokers, they offer you two different type of margin accounts. One of them is Reg-T, which is the standard margin account. This is the default margin account that you have when you use a margin account. And then they have the more advanced one, which is called portfolio margin. What I know about the portfolio margin is that number one, it's only available for US citizens. They may have changed this by the time I'm saying this, but last I checked, that was the case. The second thing is it requires a minimum net liquidity of 100,000 USD. And then you have to apply for the portfolio margin account. And what the portfolio margin account is, in short, guys, it's a different model that Interactive Brokers uses for calculating how much capital is required in your account. They mention that in some circumstances, some individual positions can actually have higher capital requirements than the regular Reg-T model. However, if you have a portfolio of options, stocks, futures, bonds, etc., it's possible that when all of those are combined and you have a portfolio margin account, that your margin can be substantially lower because it's using your entire portfolio as the calculation rather than on a symbol to symbol basis. So if you are a portfolio manager, you may want to consider the portfolio margin account with Interactive Brokers. So let's talk a little bit more about how these margin loans work for stocks trading. So like I mentioned earlier, when you buy a stock with Interactive Brokers, you're using cash all the time. You don't have to have the full cash balance. As you can see here, your cash can go negative. The more negative your cash balance is relative to your net liquidity, the more of your margin capability of your account you're actually using. So in this case, I'm not using much of my margin capabilities. And now would be a good time to explain net liquidity, excess liquidity, and maintenance margin. It's not very complex, it's actually quite simple once you have someone really explain it to you. So your net liquidity is the value of all of your assets in your account combined, marked to the market price right now. You can see here in my account, I have different positions in my account. Now, notice the Forex trade I did is showing up as a position. You can actually turn that off. And I'm gonna do that by going to account and then account window. I'll drag this over. I will scroll down using the scroll bar, and then I will just click on this arrow here where it says FX portfolio virtual FX position. I will turn that off. And now you can see the Forex position is not being shown in our daily open profit and loss. However, the Forex trade we did incur us a negative Canadian balance of 17,000, and that is having an impact on our maintenance margin. So just keep in mind that your Forex positions may or may not have an impact on your account maintenance margin requirement. Okay, so your net liquidity is the total value of your account with all of the assets combined. If the value of the stocks or positions in my account are increasing, then my net liquidity is going to be increasing. If the stocks or positions in my account are going to be going down, then my net liquidity is going to be slowly decreasing because the value of my account is now less. The excess liquidity as well as the maintenance margin, they will not change unless the following occurs. When you initiate a position, a new position, and you buy a stock, you buy a futures contract, or you initiate some sort of a position, you buy something in your account, your maintenance margin level will increase because now the broker is requiring you more capital to maintain the new position. So I can buy more shares of the stock if I want, and my maintenance margin is going to increase accordingly. Your excess liquidity is a reference number, and it's informing you roughly how much you have left to initiate new positions. every different market you trade has a different maintenance margin impact on your account. Like for example, the bond position is barely impacting my maintenance margin, whereas the stock position and the Forex trade I did are actually what's impacting most of that maintenance level right there. Let's talk about the negative cash balance. So like I mentioned earlier, when you have a negative cash balance, you're obligated to pay interest on that currency. That's how it works. What I'm talking about here will apply to buying stocks and buying various different types of investments. Shorting stocks is a different thing. It has its own set of rules for it. So I'll talk about that later in the video. Let's assume we're buying stocks. When we have negative cash balance, you're essentially short the currency. When you're short a currency, you are obligated to pay interest to somebody. In this case, you have to pay to your broker interest. They tell you how much interest you will incur. So let's say I have negative 17,000, let's say it's $18,000 Canadian, which would be, you can go onto their website and just go on the internet and search for Interactive Brokers margin. And you'll find this page right here, margin rates and financing. And you scroll down and then you can enter a balance in the currency that you have as a negative balance, and they will tell you what the interest rate is on that currency. So I'm going to scroll down and then I will enter my balance and then change the currency to Canadian because that's what it is. And then I'll click on calculate blended rate and you scroll down here and it'll give you the blended rate for your currency. And then if you really want to see the specifics, you just have to scroll a little further and it'll tell you that basically from 0 to 130,000 Canadian, this is a negative balance. So what this means is that from 0 to negative $130,000 Canadian, this is how much interest the broker will charge you. In this case, 6.5%. And then this tool up here is going to be helpful for calculating the interest if you have larger balances, because in this case, if you have more than 130,000, then you get a lower rate. So anything above 130,000 in negative cash, you're paying 6% on, and that will give you a different blended rate on the total amount. So if I put in, let's say I just put in another 0, 180,000, right? Calculate the blended rate. My blended rate would be 6.4% because I'm paying 6.5 on 130,000 and then I'm paying 6% on the extra 50,000, okay? So just keep in mind that when you have negative cash balances, you're going to be incurring interest and they will subtract this interest from your account normally one time per month, and it happens to be normally around the beginning of the month. The same thing goes for when you're paid interest in your account. If you're paid interest for positive cash balances or any other thing that they pay interest on, you're going to receive it probably around the same time, which is normally at the beginning of the month. And there is a video explaining how Interactive Brokers pays interest on idle cash. You can go check it out right there in the corner. However, stick around here because this video is better. It's going to be very hard to answer all kinds of questions regarding this, but new investors, they might ask a question like, well, why would I have a negative cash balance in a currency if I'm just going to be paying interest on it? As I may have mentioned earlier in the video, the investor might have a specific reason for maintaining a negative cash balance. Either potentially they're bearish on the currency exchange rate. So potentially it's a business or an institution that does business in the US dollar as well as the Canadian dollar. They have decided that for them going short on one of the currencies is a trade that they're willing to accept. So they might be willing to pay interest on one currency to incur interest on another currency. This would be described as something like a currency arbitrage trade. I'm sure banks have been doing this for thousands of years. That would be one reason. The other reason would be maybe they're using their cash to be in a leveraged stock position, right? Maybe they're really bullish or really bearish on a stock, and maybe they're very experienced in managing their trades. That could be another reason why they're comfortable with a high amount of a negative cash balance. So I just want you to understand that it's not really a black and white thing having a margin account. There's multiple ways that you can use the flexibility that a margin account offers you. So just keep that in mind. You're going to have to do some more studying. So some of you guys coming from potentially these Forex brokers or futures brokers, discount brokers, often they offer something called an intraday margin. This might be one of your questions. You might say, well, does Interactive Brokers offer a lower margin when you're trading stocks intraday, which means during real-time hours? The answer to that question, unfortunately, is no. Interactive Brokers does not have intraday margins for futures or for stocks. It's pretty much the same overnight or intraday. So for some traders, this might be a disadvantage because you might have potentially a strategy that you develop that uses higher position size, but you're using a lower amount of risk per trade, like sort of a day trading or a scalping strategy. If you're doing that type of trading, you might prefer a discount broker. Now, what you also need to understand about day trade margins is that a lot of the times those day trade margins are giving you leverage that is really, really out of the ballpark. So what I can tell you about Interactive Brokers' margins is that these margins that they offer are typically in line with what the appropriate margin should be in a well-balanced portfolio. So if you invest in stocks or something like that and you trade futures as a hedge, so let's say you're long a bunch of technology stocks and you short the NASDAQ futures as a hedge, the margin requirement for the futures position is going to be substantially lower relative to your net liquidity, assuming that you're running a portfolio of tech stocks. That's like, 100,000 USD or more. You understand what I'm saying? The next thing that's really, really important to understand regarding margin trading is that margin requirements are subject to change. So when you look at your maintenance margin currently, you have to understand that this is what the broker is currently requiring you to maintain in your account. This amount is subject to change based on how volatile the market is. During March 2020, margin requirements were significantly higher for futures, I remember that, and for stocks as well. So the broker may have been requiring maybe 100% or even more of the capital for US stocks. For futures, it would have been, a lot higher than where it is now. So you have to keep that in mind. If the market is experiencing volatility, or if we're having some sort of a macro global economic scenario where there's a lot more market volatility, the brokers are going to increase their margin requirements, which is going to increase your maintenance margin. If the broker raised up your maintenance margin and it is now too close to your net liquidity, they're going to give you a liquidation warning and you're going to have to deposit more cash in your account to handle the new maintenance margin for the higher volatility conditions. Obviously, this is not going to happen every single day, every single week, every single month. You can have long periods, like for example, the last year, margins have stayed very steady and pretty much low compared to where they were in March 2020 or in the year 2020, because that year was an exception. Since I'm on that topic, we can talk more about how to avoid a position liquidation. As you know, if your net liquidity is approaching your maintenance margin, if your excess liquidity is negative, it means that your net liquidity is no longer enough to handle your maintenance capital required. So that is when the broker is going to start liquidating your positions automatically in your account. And they are going to inform you well before that. If your net liquidity is approximately 10% away from your maintenance margin level, they're going to send you a message that looks something like this on the screen. And they're going to say, hello, your net liquidity is 10% approaching your maintenance level. And number one, if margins change, your account could be subject to immediate position liquidation. Or number two is if your net liquidity drops below that point, meaning that your positions went against you, you could also be subject to the position liquidation. Now, obviously, number two is the more likely scenario, which is you're trading a bunch of stocks or a bunch of options leveraged, and then they're going against you and you don't know what to do. You're just sitting there like a friggin' sack of potatoes, which is pretty common, especially in your first couple of years. You freeze if you're not used to what this game is all about. And then they end up liquidating you. It happened to me in 2021 on NASDAQ futures. So let's say I go crazy and I want to buy a lot of stock here. So I put in an order to buy 150 shares of Apple. And you can see that the new maintenance after I initialize this position is going to be around, let's say it's around 13,500. So let's start by initializing this. I'll just buy it at the ask. You can see now we have negative cash in USD, which is fine because we're trading on leverage. Maybe we plan on selling this trade within the same day. We're day trading, For day trading, margin is pretty much, essential. So you can see now we have a maintenance margin level of 13,500. I would consider this, based on the current risk profile of this account, we're trading a couple of stocks here. This is a relatively safe level right here. The only way that this would become unsafe is if this stock position, these two stock positions, started aggressively dropping against our positions. And given the current market circumstances, the current market environment, the current volatility and all that, it seems to be less likely. Of course, this can change overnight. So just be aware of that. So I've established the fact that this is a relatively safe level of maintenance margin. The next thing you need to be aware of to avoid a position liquidation, of course, is how much you are going to be making or losing if the positions in your account drop or go in your favor. As an experienced trader, this might sound super silly, like, wait a minute, I know how much I'm making or losing if I go into the trade, but some of you beginners don't. You might just go ahead and buy 100 shares of a stock and you're just looking at your P&L go up and down, and you don't actually know that you're now trading for $5 a cent in the stock. meaning that every cent the stock goes up or down, you're making or losing 5 USD. You need to be very well aware of how much you are willing to lose, number one, and how much you're actually making or losing, depending on how much the stock is moving in your favor or against you. If you're really on top of your game with that, you're going to decrease your probability of a position liquidation, okay? And some people, I've seen traders that kind of neglect this, like they trade options and different types of complex positions, and they're not necessarily considering at all times how much their net liquidity is going to be impacted if the stock were to drop by $2 or if it were to go up by $3 in their short calls or something. You understand what I'm talking about? You have to be very well aware of how much you're going to be making or losing based on how much these stocks are moving and your position size in those stocks. Okay, so right here, guys, is a special case example I wanted to demonstrate to you guys because this is an example of a trading account where the excess liquidity is quite low, and actually under some circumstances, this would actually be a high risk scenario to get liquidated. But because of the positions in this account and the kind of positions that they are, it's actually a low risk to be liquidated. So what I've done in this account is I'm invested in treasury bills, Canadian and USD. One of them is an ETF for Canadian treasury bills. The other ones are actually US treasury bills I bought in the secondary market with IB. So you can see there's a negative cash balance of 12,000 Canadian. And the reason for that is because I actually pulled that money out as a withdrawal. They'll allow you to pull cash out of your account up until your excess liquidity approaches zero. So what I did as an experiment here is, because these are low risk positions and they don't depreciate, or at least they're not supposed to, I pulled out as much cash as I possibly could out of the account and then take a look at how that's going to impact the maintenance and excess liquidity. The first thing is that they did send me a message about the cash balance being negative, and then they did send me that message about when the excess liquidity is 10% away from where it would be to start getting position liquidated. Okay, and that's normal because I pretty much made my account go close to my maintenance level. So this is an example where you can see the net liquidity is 2.5 thousand and the maintenance level is 2.3K. And what the broker is essentially telling us here is that if the value of our account were to drop by $184, we would be subject to automatic position liquidation. Now, this right here is a low risk profile for this account because it's invested in T-bills that only give me a profit. However, if this was a stock portfolio, this would be an extremely high risk situation where, depending on how long or short you are in the stock, it could potentially take a very small movement of price in that stock and the broker would immediately start liquidating your position, the one that's going against you. Keep that in mind. This is an extreme example I wanted to present to you because depending on the kind of assets you're invested in, this is a high risk scenario or potentially a lower or medium risk scenario. That's why it's important to understand that margin investing is for experienced investors only. You have to understand exactly what is likely to happen if X, Y, and Z occurs, and you have to be ready for certain things to happen. Okay, now the last thing is we're going to finish off with how does shorting work with Interactive Brokers. So shorting has its own set of rules. So when you short a stock, guys, you're basically borrowing the shares from the broker. You're borrowing them from someone. The broker has to find those shares. And then you go into the market and you sell those shares to some other trader. When you sell those shares, you get cash, right? Because you're selling the shares. You get cash in your account. So you might have a positive cash balance when you short a stock. You're going to be short the stock, but you're going to be positive in cash normally. And the fee structure for shorting a stock is different. When you short a stock, there's something called a fee rate, which is basically the interest rate of the stock. So if you want to see what that fee rate is, depending on whatever watch list you use, I'm going to right click on one of these columns, go to customize layout, then go to short selling on the available columns. I'm going to find short selling, and then I will add in the fee rate there. I'll apply it. And the fee rate is basically how much it costs per year to go short this stock. So you can see, for example, this penny stock here, GCT, which is not really penny stock anymore. It has a 9% fee rate. It's going to cost you 9.3% per year to be short on this stock. So if you shorted 100,000 worth of this stock, you're going to pay about $9,000 per year to remain in that short position. And the interest will be accrued every day that you remain short the stock. Everything regarding margin trading that I described to you in the accruing of interest, it's always when negative cash balances and short positions are held overnight. If you have a negative cash balance intraday and then you cover it by the end of the day, you're not going to accrue any interest on that. So when you're short a stock, you pay the fee rate. So that's one fee that you have to pay. However, when you're short the stock, you also get cash from it. And the cash that you get from the short position, you can actually accumulate some interest on that. So you go to this page at interactivebrokers.com, pricing /short-sale-cost, short sale cost, and then you scroll down and then you can basically see the interest rates. So these are the interest rates that explicitly apply to cash that you receive from shorting a stock. So if you short a stock and you get $100,000 from it, they actually pay you nothing on that. And more than 100,000, from 100,000 to $1 million, then they'll pay you 4% on the cash that you got from shorting the stock. So what this can do is if you're a really big short trader, this can offset the fee rate for the stock. And if the stock doesn't have a high fee rate, potentially this could even be earning you a positive return on the cash that you generated from shorting the stock. So that's something to keep in mind. All right, guys, I think we covered a lot of stuff in this video. If you have any questions regarding margin trading with Interactive Brokers, leave them down below. I will try to answer them as soon as possible. Obviously, just allow me some time because I get a lot of questions here on this channel. All right, guys, I really appreciate you watching this video. I hope you learned something. I hope you feel 25% smarter. Check out this video right here if you want to learn how to set up an advanced scanner in TWS that replicates something like a FinViz scanner or a TradingView stock screener. Cheers, see you in the next one. Love you, bye.